FirstRand's first half diluted headline earnings per share rose 9% to 101 cents, helped by a decline in bad debts and higher income from loans. Earlier today, Samantha spoke to the company's CEO, Sizwe Nxasana, and asked him about the company's performance.
F&B, they've started a couple of years ago just focusing on making sure that the fundamentals of the business and attracting new customers, driving transactional volumes, migrating customers to lower digital, or at least electronic banking channels was being driven, and all that has contributed to the growth in customer numbers, in volumes, as well as in lending. And of course, innovation is one of the key aspects and characteristics of F&B, and we've seen that really increase over the last 6 months. In fact, over the last 2 years, they've seen a number of new products that have been launched. We just consider a number of the pockets, starting with the mass market as an example. They now have just over 4.4 million customers in that environment. A lot of them use electronic channels to transact. In the commercial segment, there's been a lot of focus on raising deposits, on advances or lending to particular sectors of the small and medium enterprises. In the consumer space, which is where the home loans business or the credit card business sits, there's also been very good growth in transactional volumes, which is driving both non-interest revenue as well as net interest income.
Also incredible growth during the period, 60% year-on-year increase in normalized earnings. Also interesting that bad debts, impairments have started to come down on this end, and you're also growing your business. You're targeting corporates, you've perhaps re-strategized in a sense. Take us through what's driving this underlying growth in earnings.
The number of factors. Firstly, the WesBank's presence in the point of sale is quite an important factor in driving growth. So as we see the growth in motor vehicle sales in the country, WesBank would have their lion's share, I guess, of the growth that is coming through there. Secondly, the strategy of just making sure that we were targeting customers again that were low risk, of focusing on reducing costs, because it's quite important to be a business that is efficient, has been quite important. So we've seen costs, the core costs in WesBank have only gone up by 8%, which we think is quite good. And at the same time, focusing on some of the new growth areas that you just indicated, where WesBank was underrepresented. So fleet management rental, as an example, is a particular area that we're focusing on, and so is the corporate environment in asset-based financing. And thirdly, the public sector is a particular area of growth. And fourthly, we're starting to see WesBank growth in countries outside of South Africa. In other words, they operate on the back of the F&B infrastructure in countries such as Namibia, Botswana, Zambia, Mozambique, and so on.
The vehicle sales market has staged a strong recovery since the 2008-2009 recession. We've seen a lot of restocking taking place by businesses, by consumers. At WesBank, you've seen 60% growth in the interim period. The question is, how sustainable is this growth, given the fact that many are saying that the growth in vehicle sales is going to start slowing down?
Well, I'm not sure whether we can sustain 60% growth in earnings. However, I think the strength of the WesBank franchise is such that we should be able to continue to grow the business. At the same time, as I indicated, there are a number of pockets where WesBank's representation is actually quite small, is not commensurate with the level of market share which WesBank has in other areas. And thirdly, I talked about growth in Africa, which is becoming, obviously still small, but it becoming an important contributor to the growth in WesBank. And at the end of the day, we're quite comfortable that, the business will be able to grow going forward.
RMB, of course, is one division of FirstRand where we've seen profits falling back for the interim period. Profit before tax slipped by 15%, of course, coming off a strong base over the past few years, but also operating in a very competitive environment. Just take us through the performance of the various divisions within RMB.
It's an approach, again, that we've been focusing on across the businesses. In other words, making sure that we adding better quality business to our base, which is quite important. So if you look at RMB, there's been a particular focus on driving client activity as opposed to a larger focus in trading activities, which tend to be quite volatile, especially if we look at just the debt or equity markets that we've had in the last year. So there's been that kind of focus, but at the same time, if you look at the divisions within RMB, just starting with the biggest division, the investment banking division, the strength of the franchise is such that RMB investment banking is able to still attract a lot of corporate activity. It may be in advisory, in structuring, in lending. All those activities are doing quite well, even in an environment which is benign or where we don't see much volumes because of the low GDP growth that we see in the country particularly. The second area in fixed income, currency and commodities has been doing quite well, despite the fact that commodity prices have been quite volatile as well. There are a number of areas which in fact benefit the fixed income, currency and commodity space, especially because you see customers who may be careful not to try and do hedging solutions themselves, and therefore we would benefit from the uncertainty or some of the volatility that we see in the market.
Let's talk about Africa. As you grow into Africa, the costs need to be factored in. Just looking at FNB Africa, you had operating costs increasing there by some 23%, a strong focus on capital investment and in growing your tentacles into the continent in areas that you've identified growth. How are you managing this cost factor as you extend your continental footprint?
So it's important to strike a balance between your existing operations as well as how you invest and where you invest your capital. So it's quite an important strategy. So if you look at what we're doing as FirstRand as a whole, the number of operations where we have subscale operations such as in Mozambique, Tanzania, Zambia, India, where we are now scaling up and growing those operations, but we do so quite judiciously as those operations prove themselves, so do we allocate more capital. And then we have new operations that we're looking at in countries such as Ghana, Nigeria, and some activities on the investment banking side in Kenya.